You work hard. You show up every day. You put in the hours. And after paying rent, groceries, insurance, utilities, and everything else life throws at you, you finally manage to save your first $1,000. Now comes the question that stops most people in their tracks. What should you do with it? Should you keep it in your bank account? Buy stocks. Invest in crypto. Open a retirement account. Or wait until you have more money. Here's the truth. The difference between people who build wealth and people who struggle financially for decades isn't usually income. It's what they do with the money they already have. Most people spend years waiting for the perfect time to invest. But the perfect time rarely comes. Meanwhile, inflation continues to reduce the value of their savings. Opportunities pass by, and valuable years are lost. In today's video, I'm going to walk you through exactly how to invest your first $1,000 in 2026. Before we talk about where to invest your money, we need to talk about the biggest mistake most people make. They think saving money is enough. Now don't get me wrong, saving money is important, but saving alone won't make you wealthy. Imagine you put $1,000 in a regular savings account and leave it there for 10 years. You still have your $1,000, but because of inflation, that $1,000 buys less than it did before. The cost of housing rises. Healthcare gets more expensive. Food prices increase. Everything costs more over time. In other words, money sitting still slowly loses purchasing power. That's why investing matters. Investing allows your money to grow faster than inflation. It allows your money to work while you're sleeping, while you're at work, while you're spending time with your family, and over time, that growth can become incredibly powerful. Before investing your first dollar, ask yourself one important question. Do you have an emergency fund? Life is unpredictable. Cars break down. Medical bills appear. Jobs change. Unexpected expenses happen. If you invest money that you might need next month, you could be forced to sell your investments at the worst possible time. That's why building an emergency fund should be your first priority. A good target is 3 to 6 months of essential expenses. If you're still building your emergency fund, consider splitting your $1,000. Put a portion into savings. Invest the rest. Remember, successful investing starts with financial stability. Think of your emergency fund as the foundation of a house. Without a strong foundation, everything built on top becomes vulnerable. Step 2. Eliminate high-interest debt. Next, let's talk about debt, specifically high-interest debt. If you're carrying credit card balances with interest rates of 20% or more, paying off that debt should be a major priority. Here's why. Imagine you invest your money and earn an average annual return of 8%. Sounds good, right? But if your credit card is charging 22% interest, you're still losing money overall. Paying off high-interest debt often provides one of the best guaranteed returns available, because every dollar of debt you eliminate is money that stops working against you. Before trying to build wealth, make sure you're not dragging a financial anchor behind you. Step 3. Open the right investment account. Now let's talk about where your investments should actually live. Many beginners focus on what to buy before deciding where to invest. But choosing the right account matters. For many working professionals, retirement accounts can offer significant tax advantages. If your employer offers a retirement plan with matching contributions, pay close attention. Employer matching is often compared to receiving free money. If matching is available, consider contributing enough to capture the full match whenever possible. Beyond retirement accounts, brokerage accounts provide flexibility and accessibility. The exact account you choose depends on your financial goals, income, and timeline. The important thing is getting started. Don't spend months researching every detail. Action beats perfection. Step 4. Invest in low-cost index funds. If you're wondering where most beginners should invest their first $1,000, here's the answer. Low-cost index funds. They may not sound exciting, but they have helped create millions of successful investors. An index fund allows you to invest in hundreds of companies at once. Instead of trying to pick a single winning stock, you're investing in a broad section of the market. Think about it. Many professional investors struggle to consistently outperform the market. Yet many everyday investors achieve excellent results simply by owning diversified index funds and staying invested for the long term. This approach removes much of the guesswork. It reduces risk, and it allows you to participate in the growth of businesses across multiple industries. consumer goods, financial services, and more. The goal isn't to find the next overnight success story. The goal is to consistently grow wealth over decades. Step 5. Understand compounding. Now let's talk about the most powerful force in investing. Compounding happens when your investment gains begin generating gains of their own. At first, growth seems slow, sometimes painfully slow, but over time, the process accelerates. Think of a snowball rolling downhill. It starts small, but as it continues moving, it gathers more snow and becomes larger and larger. That's exactly how wealth building works. The earlier you start, the more time compounding has to work in your favor. And time is often more valuable than the amount of money you invest initially. Common mistakes to avoid. Let's cover a few mistakes that can derail your progress. Mistake number 1. Trying to get rich quickly. Building wealth is usually boring. It's consistent, it's discipline, and it takes time. Mistake number 2. Following investment trends on social media. Just because everyone is talking about something doesn't mean it's a smart investment. Mistake number 3. Panic selling during market downturns. Market declines are normal. Volatility is part of investing. Successful investors understand this. Mistake number 4. Checking your portfolio every day. The market moves constantly. Focus on your long-term goals instead of short-term norms. Your first $1,000 isn't going to make you a millionaire overnight, but it can be the beginning of something much bigger. Financial freedom doesn't start with a huge investment. It starts with a decision. A decision to take control of your future. A decision to stop waiting. And a decision to let your money work for you. Remember this. You do not need to be perfect. You do not need to know everything. You simply need to start. If you found this video helpful, make sure to like this video, subscribe to the channel, and turn on notifications for more personal finance and investing content. And in the comments below, tell me this. If you had $1,000 to invest today, where would you put it? Thanks for watching.